Well, good morning and welcome to the Capital Group's YouTube channel for our first webinar of 2021. We hope that you and your family enjoyed a wonderful holiday and a very happy start to the new year. I'm Kevin FitzPatrick, a partner at the Capital Group and CEO of the Government Contracting Insurance Company. We provide group health insurance, 401k, and commercial insurance strategies to the Washington, D.C. business community. Today, CEO of the Government Contracting Insurance Company. We provide group health insurance, 401k. Sorry about that. Today, we're going to spend about an hour together with our panel of legal and HR experts reviewing the most recent congressional COVID emergency relief legislation. Included in this legislation are employer student loan repayment benefits, flexible spending account rule changes, new DOL OSHA COVID-19 training, and mandatory preparedness plan requirements. This is being done on a per state basis, and we'll walk you through what certain states are now requiring. There are new rule changes that extend the tax credit portion of the FFCRA for employers that voluntarily offer paid sick and family leave. These credits are essentially government-funded paid sick leave for employees that cannot work due to COVID-related circumstances. As of yesterday, the SBA released two interim final rules on PPP eligibility and forgiveness, and another on second-round PPP loans. They are pretty extensive. The first is 82 pages long, and the second is 42 pages. But our own Stephanie Wilson spent the better part of last night parsing through the final rules and is going to share with us the latest and the greatest from the SBA. Now, still to be decided, and we'll be addressing this in an upcoming February webinar, is the issue of return to work employer COVID-19 related liability. What happens if you have an employee who refuses or is unable to get vaccinated, but the job requirements dictate or the client dictates vaccination as a requirement? This is a fluid situation right now, and to a high degree, we are in uncharted territory. We know there will be a lot of uncertainty on how to safely bring employees back to the office or client work site. But our legal and compliance department and our strategic partners are ready to help you with your questions, provide guidance and advice all throughout what we hope is now the beginning of the end of the pandemic. So please don't hesitate to reach out. Now with that, I'd like to welcome our panel of experts today. We have Kathy Goyne, CEO of OpsPro. OpsPro is a GovCon-centric focused service provider for back office and operational support. Kathy and her OpsPro team deliver a wide range of GovCon offerings, from on-demand consulting to full outsourcing of all operational processes. Kathy is a trusted Capital Group partner, and we're thrilled to have her here with us today. Stephanie Wilson is a partner at Berenzweig, Leonard law firm and a graduate of Georgetown University Law. Stephanie is the Director of Government Contracts at Berenzweig Leonard and represents government contractors of all sizes in bid protests, claims litigation, and advises contractors on a wide variety of legal matters. Also joining us, Lawrence Martineli, former GovCon executive and Senior Vice President of HR at General Dynamics. For the past 6 years, Lawrence has been the Chief Operating Officer here at the Capital Group. Throughout today's program, we encourage everyone to please submit your questions all throughout. I'll be monitoring them on the phone here. I promise you, if we don't get to your question, feel free to contact us post-program, and we'll do our very best to answer it. Our contact information is going to be posted, and this program is being recorded. And it's also going to be posted up on the Capital Group's YouTube channel for future reference. We have a lot of information to share and cover today, so without further delay, I'm going to introduce Stephanie Wilson to kick things off. Stephanie, please take it away.
Thank you. So today I'm going to be discussing the new PPP legislation that has come out, and as Kevin mentioned, the most recent regulations that were put out by SBA just the other day. And so PPP has been a huge issue for lots of businesses around the country this year. A lot of businesses took PPP loans in the spring and are currently either in the process or about to go through the process of their forgiveness applications. And in late December, President Trump signed into law the Economic Aid to Hard Small Businesses, Nonprofits, and Venues Act, which the shorthand is the Economic Aid Act, which made another round of PPP loans available. And so I'm going to assume most people watching today either have already applied for and received a loan in the first round, or they're interested in learning more about the forgiveness process, or are considering obtaining a loan, either a second loan or their first loan through this new round of loan that is being made available. So today I'm going to discuss sort of three things related to the new PPP legislation. So first, what are the current requirements and rules for obtaining a PPP loan, whether it's your first loan or if it's a second draw loan? Second, what's required to apply for and obtain forgiveness? And then third, I'm going to touch on a little bit, since I know we have a lot of government contractors that are watching today in our audience, to briefly discuss some specific considerations that they should take into account as it relates to applying for forgiveness. So first, turning to the sort of a summary of where we stand now after the Economic Aid Act was passed. So that act added $284 billion to the Paycheck Protection Program for small business forgivable loans. And this brings the total program level to over $800 billion between the first and the second round of PPP money. And so the last day to apply for and receive a PPP loan from this new round of funds is March 31st of this year. And on January 6th, so 2 days ago, the SBA issued two interim final rules, probably the first of many interim final rules that we'll see implementing this legislation. So the first one, what it really did was consolidated all of the prior final rules that SBA has put out over the last several months on the PPP loan program to date, and also incorporated some of the changes and updates from the new legislation. Then they also issued a second interim final rule on January 6th, which really focused on the terms and conditions of these second draw loans. So those loans that are being taken by businesses that have already received and used their first PPP loan and still have a need for a second loan. So looking to the interim final rule as it relates to those who are getting their loans for the first time. If you could move to the next slide on that, please. So with limited exceptions, the standard for eligibility for first-time borrowers has not changed from what we saw earlier this spring. There are a few categories of businesses that are now eligible that weren't necessarily before, and we have a few exceptions for businesses that are not eligible to apply for loans from the second round. And so that would include live entertainment venues that are receiving grants under the Economic Aid Act that was passed. So, theaters, things like that. There's also an exception now, businesses that are not eligible now includes businesses in which the president, vice president, head of an executive department, or a member of Congress, or the spouse of any such person owns, controls, or holds at least 20% of any class of equity. And then also publicly traded companies. So these are some of the businesses that maybe received a lot of attention the first time around, some negative press and questions as to why they received loans. And so I think that is one of the reasons why they've made this change this time around. As far as the process for calculating the loans, that's still the same for first-time borrowers as it was previously. So you take the average monthly payroll cost times 2.5, and that's capped at $10 million for first-time borrowers. And the loan application also continues to require this good faith certification, which we'll talk about in a little bit more detail later on. But that certification requires that the borrower certify that the current economic uncertainty makes the loan request necessary to support ongoing operations of the applicant. Now, SBA has released a while ago a regulation that states that it's providing a safe harbor for those borrowers who received less than $2 million. They're going to be automatically deemed to have been made that certification concerning the necessity of loan in good faith. And as we'll discuss, those that are above 2 million, receive loans above $2 million, SBA, sort of has reserved the right to look into that certification a little bit more closely. The next thing that I'll discuss are the new terms and conditions that are specific to these second draw loans. So again, those are the second PPP loans that are made to borrowers who previously received a PPP loan and will use the full amount of that initial loan for the authorized purposes on or before the expected date of disbursement of a second draw on the loan. The eligibility is a little bit different. It's more narrow for those companies to receive a second PPP loan. So with limited exceptions here, you need to have 300 or fewer employees, where if this is your first time applying for a loan, that number is 500 employees. Also, a second-time borrower will need to demonstrate that they experienced a revenue reduction of 25% or greater in 2020 relative to 2019. And so the way the SBA has captured that is that a borrower must calculate this revenue reduction by comparing their quarterly gross receipts for one quarter in 2020 to the same quarter, the corresponding quarter in 2019. Alternatively, what the new regulation has said is that a borrower could satisfy that by showing through their annual tax return that they had a reduction in annual receipts of 25% or greater in 2020 compared to 2019. The reasoning behind that is the only way that you could have an overall reduction of that amount is if you at least had a reduction in at least one quarter of at least 25%. And there are a few other entities that are ineligible for a second draw loan. So obviously, if you're ineligible to receive a first loan now, you can't receive a second loan. Also, entities that are primarily engaged in political activities or lobbying activities cannot apply for the second draw loan, as well as entities with certain specified ties to China are not allowed to apply for a second draw loan. When we look to how much of a loan you can receive the second time around, for most entities, you're using the same calculation, 2.5 times your average monthly payroll. For businesses that are in the accommodations and food services operations, that calculation is actually 3.5 times the average monthly payroll. And for all borrowers, it's capped at $2 million. So the first draw is $10 million, and this is much lower at $2 million. So then looking to what these loans can be used for, this is the same for both first draw and second draw loans, regardless of whether you received a first loan or not, or when you received your first loan, the uses for them are the same. As was made clear sort of the first time around with the PPP funding, this includes payroll costs, mortgage interest payments, rent payments, utility payments. So the focus is on payroll costs, but there are some additional non-payroll costs. As part of the new legislation, Congress added some additional non-payroll costs that are of particular importance to businesses that they are allowed to use these PPP funds for. So those include covered operations expenditures. So for example, software or cloud computing services that facilitate business operations like HR, payroll, accounting, expenses for certain worker protections. So PPE, improvements to ventilation or air filtration, erecting physical barriers, the plexiglass panels, things like that. Another category that was included is actually covered property damage costs. And what this is referring to is costs that are related to property damage and vandalism or looting due to public disturbances that occurred during 2020 that were not covered by insurance or other compensation. So that's an additional covered non-payroll cost. And also there are certain limited supplier costs that can be included as well. So when you're looking to how these loans can be allocated, the funds can be allocated, there's a minimum 60% allocation of the loan to payroll costs that is required to attain full forgiveness. And then up to 40% of the payroll, or up to 40% of the loan proceeds can be used to the other authorized non-payroll costs. And when you're applying for the loan on the application, you need to certify that the loan proceeds will be used only for these authorized purposes. So payroll, and then these specific authorized non-payroll costs. And one other thing that is really important this time around that has been confirmed by this new legislation is that business expenses paid with proceeds of forgiven PPP loans are now deemed tax deductible by the IRS. So this is actually a reversal of previous IRS guidance. And this is obviously a big deal for businesses. One caveat is that this legislation only applies as to federal taxes. So states are not necessarily required to provide the same treatment. That's really going to happen on a state-by-state basis. But regardless, it's still a real benefit to businesses that this is now considered tax deductible on the federal side. So now turning to the loan forgiveness process. So in the initial round of legislation regarding the PPP loans, there's a lot of discussion of this covered period. This is the period that is now defined as beginning on the date that the lender disperses the PPP loan, and it ends on any date that the borrower selects between or beginning on the date 8 weeks after the disbursement or ending on the date 24 weeks after the date of disbursement. So this is actually a change from before. Previously, you had to elect either an 8-week covered period or a 24-week covered period. Now borrowers have the flexibility to choose a covered period that falls between the 8 to 24-week window. So because of that, in some of the prior legislation, there was this, and even still in the loan forgiveness documents, there is this term alternative covered period. That's no longer needed. It's irrelevant, essentially, now that we have this flexibility to choose a date between 8 and 24 weeks. So when do businesses need to apply for loan forgiveness? So what the legislation states is that if you do not submit to your lender a forgiveness application within 10 months after the end of your loan forgiveness covered period, then you will need to begin paying principal and interest after that period. So you could still apply for forgiveness, I believe, under the current rules, but you would have to start paying it back once that 10-month period is ended. So for eligibility, as I mentioned before, you need to be eligible for forgiveness. You need to use all of the loan proceeds for forgivable purposes. You also need to maintain certain employee and compensation levels, or demonstrate that an applicable safe harbor or exemption applies. So there are some instances where, if your business certainly just could not stay open during this time period, then there's a safe harbor exception that would allow you to still receive full loan forgiveness, even if you weren't able to maintain the employee number and compensation levels during the entire covered period. And as far as how the forgiveness is calculated, so to receive the full amount of forgiveness, so forgiveness of the full loan, you must use at least 60% of the PPP loan for payroll costs, and therefore not more than 40% of the loan forgiveness amount attributable to those allowed non-payroll costs. And the forgiveness amount is calculated in this proportional manner so that no matter what you get, at least 60% of your forgiveness is related to payroll costs. So there are a few different PPP loan forgiveness applications out there, depending on the borrower's situation. So there's the standard PPP loan forgiveness application. There's what's called the easy loan forgiveness application. And so you can use the easy loan forgiveness if you did not reduce salary or wages for more than 25% during the covered period. And you either did not reduce the number of employees or the average paid hours of your employees between January 1st, 2020 and the end of the covered period, or you can demonstrate that you are unable to operate during the covered period at least at the same level of business activity due to compliance with specific health and safety requirements or guidance out there. as part of the new legislation, SBA has been directed to create another forgiveness form, application form, and that is directed towards those businesses that received a loan of $150,000 or less. And so that is supposed to be even more simplified than the easy form that we've seen. And so this simplified forgiveness application should be out later this month. Regardless of the size of your loan, what form you're using to apply for forgiveness, all borrowers must retain records relevant to their forgiveness form that prove their compliance with the PPP requirements. So employment records, payroll, what you spent your funds on as far as those allowable non-payroll costs. So, to show that you paid rent, utilities, etc. And so you want to show keep any documentation that shows how your loan amount was calculated and how those proceeds were used and how your forgiveness amount was calculated. And the loan applications themselves state how long various records must be retained. But we generally recommend that you keep those records for at least 6 years in the event that there is an audit. And so, a big part of this process is making sure that you can demonstrate, the need for the loan and how the loan was used. One other new thing for this legislation, which is also very good for those businesses that have an EIDL loan. So the Economic Aid Act repealed the CARES Act provision that had required SBA to deduct EIDL advance amounts received by borrowers from the forgiveness payments amounted by SBA or remitted by SBA to the lender. So for those borrowers who have already gone through the forgiveness process, because there are some, if they had these EIDL advance amounts previously deducted from their forgiveness amounts, the legislation does say that forgiveness amount will be remitted back to them by the lender together with interest to the remitting state. I think we'll probably still need to see exactly the mechanics of how that happens, but there definitely is still out there. So even if you've already received forgiveness, this applies to you. So one thing that we've actually seen a lot of questions from our clients is this Form 3509, which is the Paycheck Protection Program Loan Necessity Questionnaire. So this is a form that I think has caused quite a stir when it was released. It must be completed by loan recipients who received more than either $2 million or more. And so SBA states in the form that the purpose of the form is to facilitate the collection of information that the loan reviewers will use to evaluate that good faith certification that I mentioned earlier. So that certification that the economic uncertainty made the loan request necessary. The reason that it's only needs to be completed by loan recipients who received at least $2 million is, as I mentioned before, the SBA has created this safe harbor for those businesses that received less than $2 million for their loan. Now, this form, I think, really took businesses by surprise, especially because if you look at the information that is requested in this form, so the loan necessity certification that you made at the time that you applied for the loan is a forward-looking one, right? Like at the time you're applying, it's uncertain. That's kind of the point of the certification. You don't know what is going to happen in the coming months. And especially if you were applying for this loan in March, April, May, like very early on, there really was no idea what was going to be happening over the summer, in the fall, whether you would need this loan or not, whether your business would be able to stay open. And so a lot of companies, made that business determination that there was a lot of uncertainty there, and that they needed to apply for this loan to make sure that they were able to maintain their steady business operations. So SBA says that it is still going to judge the truthfulness of that initial certification based on the circumstances that the borrower was in at the time the certification was made. But I think what is causing concern for a lot of companies now is that the SBA is looking for information that goes beyond what the company had to certify at the time that it applied for the loan. So, for example, on this form, they're asking for a comparison of gross revenue in Q2 of 2019 to 2020. So, you're looking at when we're really in the thick of it, April, May, June. And for many companies, that's after they made the application for the loan, especially, in June, the funding, I believe, had run out. And so if your gross revenue in 2020 was higher than it was in 2019, a borrower might worry about that from an optics standpoint. You're concerned, does that mean that I didn't have this business, this uncertainty of continuing operations? But I think that the fact that a business was successful during that time period should not indicate that they didn't need the loan. I think what it indicates is that the loan did what it was supposed to do. It supported ongoing business operations. Another thing that the form is asking for is repayment of debt and distributions to owners during this time period. I think, again, a lot of businesses are worried, well, okay, we made our sort of standard distributions to owners that we do every year. I think if things are done sort of in the normal course, if this is something that you would have done outside of the current pandemic situation, you would have done it, before, in 2019 as well, then you're probably fine. I think you're certainly fine in that situation. I think if it is something unusual, if you're bonusing a lot of people out who wouldn't necessarily have received bonuses, but for the loan, or wouldn't have received bonuses in 2019, I think you just need to be able to explain and justify why those actions were taken this time around. It's not automatically a problem, but I think, as with everything in this process, you need to have documentation and be able to explain, why you used the funds the way you did and how you reached certain conclusions as to the necessity of the funds. So I think that with this form, it's very easy for companies to panic a little bit. But I don't think it can be the SBA is looking to punish companies who survived the pandemic or were successful because they used this loan. The point of the PPP is not to get a business through the first 8 weeks or even 24 weeks, right? It's to continue ongoing operations. And so I think that that's just one thing to keep in mind as you're going out through this process, and that this this form, while certainly seems to be asking for a lot of information that I don't know is necessarily relevant to analyzing or verifying the certification at the time it was made. I think that it's, make sure you're working with your advisors to complete those documents. And so that way, if you are audited, you're able to have explanations. And so I think kind of in that regard, just with this whole process, with this form, with the forgiveness application, with the initial loan application, you obviously want to make sure all of your information and your certifications are accurate. You want to make sure you have your required documentation. And then specifically to this form 3509, there is a space for borrowers to provide a narrative answer. Use that to give SBA a full picture of your mindset and the uncertainty at the time you applied for the loan. One thing that we advised a lot of our clients on early on in the process when they were doing those applications was, create board resolutions or some other corporate resolutions that really documented your thought process at the time, because 6 months, a year, 2 years down the road, if there was ever to be an audit, it's really hard to kind of recreate or even remember what was going on, in April of 2020. And so, that was one thing that we had advised. And I think even if companies, whether or not they took those steps early on as they were applying for loans, I think now as 2020 has come to a close, now is a good time for companies to consider having a corporate resolution or another document sort of recapping the year, what the circumstances were when you applied for the loan, how that loan helped you survive the year. Do that while it's still fresh. It's still relatively contemporaneous. These audits may not occur for a couple of years. And so you want to have that documentation, I think, in hand now. So what's next when it comes to loan forgiveness? I think there's still a lot of questions, maybe more questions than answers right now. We know that SBA intends to issue a consolidated rule that governs all aspects of loan forgiveness and the loan review process. SBA has also been required to develop a forgiveness audit plan. which will hopefully create some transparency for borrowers as far as the metrics that SBA will use to determine which loans to audit, what their audit policies and procedures will be. And I think that as we did with the first iteration of PPP, we can just expect to see a number of implementing regulations and additional guidance from SBA on all of these issues, both on the application side and especially on the forgiveness and the audit side. So finally, as I mentioned, I wanted to touch on a couple of specific issues for government contractors to be aware of. So government contractors are eligible to receive PPP loans. They're eligible to receive forgiveness. There's no question about that. However, there are certain things that contractors need to consider as they're going through this process. First is that contractors cannot claim PPP forgiveness and Section 3610 funds, if they received any, for the same cost. So you'll want to make sure to segregate these costs in your records. And when you apply for forgiveness, you do not want to rely on any payroll records for those employees who are paid using 3610 funds when applying for forgiveness for the PPP loan. Also, FAR 31.201-5 requires that any rebates or credits be accrued back to the government as a cost reduction or cash rebate. So what does this mean? So I think that sort of this, maybe one of the more simple ways to deal with this is take the approach that you shouldn't be using your PPP loan to cover direct costs, right? Like you're getting those direct costs paid by the government. So that's not really a cost to you. So I think to maximize the PPP forgiveness, what you want to do is use the PPP loan to cover indirect costs as much as possible. So for payroll costs, apply as much of the PPP as you can to your indirect labor, because the amount of forgiveness is tied to how much is of the loan proceeds are used towards payroll costs. And then also there are other eligible non-payroll expenses under the PPP. So you'll want that are allowed by the PPP loan. So you'll want to apply the loan proceeds to those as well. And then government contractors will need to make adjustments on their incurred cost submissions to account for any reductions in these indirect costs as a result of the PPP loan forgiveness. Now, making adjustments for unallowable costs is not something new for contractors. This is not very unusual. I think that it's just a matter of, making sure that you're keeping records accurately so that way when you go to apply for forgiveness, you have the right supporting documentation to line up with the cost that you really applied the loan proceeds to. So again, government contractors should still apply for forgiveness. This is, in a sense, free money. It's on the table, even if there's legitimate reasons that you might not be entitled to the full amount of forgiveness. As long as you use the loan proceeds properly, I don't see any reason not to apply for forgiveness. Again, as with all businesses, what you need to do is just make sure you have good records in case of an audit. And when you're applying for forgiveness, really you need to keep records of what the PPP loan was applied to, and you'll want to make sure those records will match up to an incurred cost proposal. So I think that's where maybe most contractors aren't thinking of this from an incurred cost perspective when they're completing their forgiveness application. And so my advice is to work with your financial advisors, your accountants who are familiar with these issues, and they can kind of guide you through that process to make sure that you've got the right documentation when you're completing your forgiveness application to really maximize that forgiveness. So that was a lot of information. And, as Kevin mentioned, we're welcome to accept questions, but otherwise, I think I'll kind of wrap up for now and turn it over to the next speaker.
Well, terrific. Stephanie, thank you very much. That was a ton to digest. We've already gotten a bunch of questions in, but I'll tell you what, why don't we bring Kathy Goyne into the conversation here now, and we'll save the questions for the end. Kathy has some good information to share with us on the new legislation. Kathy?
Good afternoon, everybody. So there's really some changes that occurred in the second round of legislation that we feel is important to call out, but there's also some extensions or some issues that were in the first round that not everybody is aware of. So we want to make sure that we cover sort of the high level, just that you're aware, and then a couple of nuances to be able to bring some details to your attention, because as we've all learned in government contracting, the devil is always in the details. So the three main areas I want to focus on is first, the student loan repayment benefits, as well as some changes to the mandatory leave benefits, and then the required mandatory OSHA training and plan requirements that is very state specific and driven. So let's talk for a second about the student loan repayments. If you were not aware, in the first round of the CARES Act, you were allowed to give student loan repayments for up to $5,250 per student loan for an employee, and that would be a tax-free benefit, just like a 401k. And that was originally set to expire on December 31st, 2020. The new regulations now allow you to extend that benefit through 2025. And this is excluded from the employee income. So this is a benefit that's been given to the employees and does not count as income for them. This can be used for a current student loan or for a new loan that is coming forward. The other piece that's really important to talk about is the paid leave. So originally under the first CARES Act, you were required to offer under certain circumstances paid family medical leave or paid sick leave. Those requirements expired at the end of 20, meaning you are no longer legally required to offer that leave. Now you may choose to offer that leave going forward because it's in the best interest of your employees to keep them engaged and involved. And the tax credits still exist for those leaves, but you are no longer legally required to offer those leaves. A couple things you want to make sure that you are aware of. If somebody has qualified for leave in 2020 and that leave rolls over into 2021, you're going to want to make sure that your payroll records and your timekeeping records differentiate the fact that one was in 20 and one was in 2021, and that you have your tax records and your audit records separating that data for you. And then the last piece we just kind of want to talk about is a lot of people did not realize that there was some OSHA and state requirements in mandated training. So many states are either recommending or requiring a mandatory COVID-19 training program that must be introduced to your employees, and you must have records that these employees have taken the programs and have signed off that they've received them. And then we also have the same requirement for in various states for a preparedness plan. So as people go back to work, what do you have in place to prepare if you have a large batch of people who show up at work with COVID and expose other people? And as Kevin has mentioned, this can kind of tie back into what is the legal responsibility of an employer as it relates to people getting exposed to COVID at work, and what is your liability? And so our recommendation is, if nothing else, you make sure that you are aware in your state what these two requirements are and that you have them in place so that later on, if there are decisions made about liability for employers, you have at least done the minimum requirements by your state at this point in time. And then I did want to kind of circle back for a second on a little bit about what Stephanie talked about on the forgiveness of the PPP loan and as it relates to government contractors. So this is really going to be sort of an if-then situation for a lot of government contractors. The first is going to be what type of the majority of the contracts you have. Are they firm fixed price? Are they time and materials? Or are you an all cost plus fixed fee shop? And then the second question is going to be, did you receive some of that funding that allowed people to be paid for while they were sitting on the bench? And it's going to be probably a very big strategic-based decision for you as you look through your loan forgiveness program. In some cases, for some people, it may make sense to not seek forgiveness. You may say, you know what, my indirect rates have been stable for 5 years. I was using a line of credit for my cash flow. If I don't forgive this PPP loan, I have a nice loan at 1 or 2% interest that is much better than I get from my line of credit. I don't have to then give the money back to the government, and I don't have to change my indirect rate structure. Now, that's probably the minority company, but it's something to certainly think about as you kind of go through this process. That is very much an if-then. And then you're going to want to make sure, however you put it on your books, that you are able to differentiate either your indirect or direct costs as allowable or unbillable or unallowable, so that you still get your tax forgiveness that Stephanie talked about, right? Nobody wants to give that up. So you're going to have to move those costs into buckets that credit the government back, but still keep them on your income statement so you get your tax credits that you were looking for. So I didn't get a chance to kind of circle that back, so I wanted to make sure I threw that out there before we forgot. And I think that kind of wraps up the information I was thinking about, Kevin.
Terrific. No, thank you, Kathy. But Kathy, while we're on the topic of COVID-19 preparedness, specific to the DC region, Maryland, DC, Virginia, can you speak to those states? Are they mandatory COVID-19 plan preparation states, optional? What's it look like locally around here?
So for the training requirement programs, it is mandatory in the state of Virginia, and that is a good chunk of the folks. And then it is recommended for Maryland. So, you know, and it's one of those things right now that I don't think you can be too careful, right? Like, and then like, let's just take like this one step further. So where is your employee right now, right? You may have had an office in DC and now your employee is sitting at home in Virginia. Nobody knows, like when these regulations start landing, where they're going to start counting these employees. So this is one of those places where I really think it's, you know, it's not a tremendous amount of work. You're better safe than sorry. That if it even possibly touches any of your employees, I would definitely roll out the training program and roll out the preparedness documentation just to get it signed off on so that you're covered. Because you would hate to choose not to do it, and then later on the regulation's going to be like, well, yeah, you had an office in DC and it didn't matter there, but your employee was working from home, you know, in Virginia, and therefore we're claiming that as their work site during COVID and it applied to you. And oh, by the way, the penalties are pretty significant in the state of Virginia. I want to say it's almost $10,000 per case found. So it's not something light to dismiss.
Wow. Well, thank you. Yeah, no, that's excellent advice. And I'm sure there'll be more to come, certainly more to come from us on how to start the plan, where to get the format, the outline, the whole 9 yards.
Yeah.
So
absolutely happy to help with that if anybody needs that information.
Thank you very much. Well, why don't we bring Lawrence Martineli into the conversation here for a moment. Lawrence is going to talk about some of the new rules under flexible spending accounts that were wrapped up in the recently passed legislation. And then we're going to move on to Q&A.
Hey, thanks, Kevin. Thanks very much. So the topic, real quickly, take a few minutes, talk about flex spending accounts. And I guess the first thing I'll say is, please don't confuse FSAs with HSAs or HRAs, which are two other tools that we sometimes use in getting folks to get the maximum dollar amount out of their purchasing power, if you will, for medical expenses. So focus here is flex spending accounts. They've been around since the mid 80s or so. They fall under Section 125 of the IRS code. And they essentially allow for tax-free spending on certain medical as well as qualified dependent care expenses. Now, the biggest drawback, quite frankly, that there's been with FSAs is the use it or lose it provision of Section 125. Now, Congress has kind of lightened that up somewhat in the past 10 years, but this recent bill really loosens things up a bit, at least for the next year or so. So specifically, the carryover provision has been extended for the full amount. Currently, or I should say prior to this rule change, you could carry over $550 of unused flex spending account balances from one year to the next. And that's been extended to the full balance of whatever it is that's in your account. So essentially, at the end of the year, you've got $700, let's say, left over in your flex spending account. In the past, you could carry $550. Now you can carry the full $700, at least for the next upcoming year. Along with that is the grace period extension. Currently, it's at 2.5 months. It's now been extended to 12 months. Now, I must caution everyone and tell you that you can't have both in your plan, and it's one or the other. So you either have the carryover provision or the extended grace period, but you can't have both, or you can have neither. That's entirely up to the plan sponsor or the employer at this point. Prospective elections is another change. So prospective elections essentially means that the provision that stipulates that you cannot make any changes to your election, which you make typically at the open enrollment period right prior to the plan year. Once you make that election, you're locked in unless you have what we call a life-changing event. And that could be the birth or unfortunate death of a child or a dependent. You could get married, perhaps you lost coverage. Under those circumstances, you could make changes prospectively, meaning going forward. Under this new change, you can make that change anytime you want. You don't have to have the so-called life-changing event. As I understand it, or as I read it, that also means then that anyone who is not in a flex spending account now, meaning they hadn't made that election this past fall for 2021, could still therefore enroll in a flex spending account on a go-forward basis. I think there's more to come on that one, but that would be my reading of it. The fourth provision that was changed is that terminated employees who typically lost whatever balance they had on the day of termination now can continue to participate in the plan, can't make any further contributions, but whatever balances they have can still be utilized. In the past, once you terminated, any monies that were there essentially disintegrated. Now it gives a little bit more flexibility for those folks that maybe move on or have lost their position because of this terrible pandemic. And then finally, dependent care eligibility has changed. Now, the eligibility is as it relates to your dependent child. So if you have a child that is now up to age 14, you can claim dependent care eligibility for that dependent. Prior to this, it was age 13. So essentially, it allows you an additional year of child care expense reimbursement or tax-free spending under the provision. That's pretty much it as it relates to flex spending accounts. And again, I would just caution everyone to understand that this only affects FSAs, not HSAs or HRAs. And so those are, very different plans. They have the same essential result, and it allows you a little bit more spending power from your money. But this is specifically as it relates to FSAs. And that's pretty much it, Kev, as far as the changes going forward.
Yeah, thank you, Lawrence. Well, why don't I go ahead and bring back in our panel of experts at this point, and we'll go ahead and get some of the questions that have been put to everybody here answered. First in from Crystal. Can you share with us some insight into the ERTC? Is there a maximum per employer? And when do employers receive the funds if the credit exceeds the liability? Maybe Kathy, you want to field that one?
I think that's going to unfortunately have to be one that they're going to have to talk with their tax professionals about, just because you're going to get into a lot of nuances between the tax laws as well as your corporate tax structure. Gotcha.
Okay. This question is related to Stephanie's part of the presentation, and it's in from Patrick. Is the 25% loss provision quarter over quarter, is that applicable to all businesses?
So that applies to businesses that are applying for the second draw loan. If I'm understanding which reduction they're talking about. So what they do the comparison when you're looking to see if you're eligible to receive a second draw loan, you need to demonstrate that you had a reduction from of 25% from a quarter in 2020 and compared to the same quarter in 2019.
Gotcha. Okay, thank you. Next question is in from Firmage. Is the new requirement written around executive officers' percentage of equity ownership? Question mark. Also, when can businesses apply for the second round? Is there a new application form that needs to be completed?
I'm not sure. follow what the first question is in regards to, but the second one, I think that they are just able to apply starting as soon as the funds are available, which I believe that they were going to be made available pretty quickly. I'm not sure whether there's a separate form, whether you use the same form. That probably depends on the lender and which form that they plan to use. But as far as the process of it, the information that goes in the application, aside from those few additional points that they need to be able to demonstrate, are basically the same as if when they apply for the first time.
Gotcha. And also in from Firmage, Stephanie, if employees did not use the 80 hours of required 2020 COVID leave, does the unused portion, or can the unused portion roll over to 2021?
So I can speak to that one, and that is it's no longer required. So that's really up to the employer if they wish to offer that paid leave going forward, because that was a paid leave option.
Gotcha. All right, thank you. Another question in from Alicia Williams regarding student loan payment benefits. Can you get into a little bit more detail, Kathy, on the specifics of how an employer would go about potentially setting up a student loan debt relief platform?
Okay, so there are TPAs out there, third-party providers, just like people who do FSAs and HSAs and 401ks that have platforms that are easy to use, and they're sort of simplistic. I can't even say that correctly. But it would allow you then to do multiple schools and multiple different types of loans on one platform. And that would be my recommendation just for ease of use. Then on the payroll side, you're going to need to make sure that you set it up as a non-taxable wage earning code. Just sort of the same as like you would set up an expense reimbursement, right? You want to make sure that you're not going to set it up as wages reported.
Thank you. And we have a couple strategic partners who are in that field, so I'm happy to make that connection for anybody who is interested in having a deeper conversation about it. This question in from Betsy, GovCon specific. Does the contractor adjusted the incurred cost submission for the year forgiveness is actually received? For example, for 2020-21 year-end ICE reports?
So you will adjust it where you're recognizing it on your books. So the GAAP accounting standards say that, you know, if you have reasonableness to believe that the forgiveness is happening before you close your books, or you receive that forgiveness before you close your books, then you would recognize it in the year that you would, that the forgiveness had applied to. So let's say you did your loan in 2019. If you normally close your books in February of 2020 for 2019, then if your loan gets forgiven in January or February, then you know that data and you would apply it back. If it's outside your normal window, it becomes a question of what is the volume or the size of that loan and how applicable it is to reopen your books and reapply it back. So if you have a $5 million loan, you know, you're probably going to have to reopen your books and apply it back. If you have something much less significant, you can apply it in the year that it's been forgiven. And it's also going to also tie into your ICE standard, right? So your ICE is due 6 months after the fact. If you don't get your loan forgiveness notification till after your ICE has been submitted, that's going to be a conversation you're going to want to have with your DCA rep and say, okay, well, I just found out I got loan forgiveness. Do you want me to do this all over again and apply it back, or do you want me to apply it to the next year? And as of right now, let me clarify that. As of right now, the only government entity that has clearly made a statement on this is DOD. So DOD, and therefore DCAA, have made a clear statement on how they're expecting PPP loans to be acknowledged, which is in this cost recovery methodology. USAID and other divisions have not come out and said, yes, we agree. So again, you know, it's all unknown till we can get everybody speaking the same language and move in the same direction, which in the government's going to take what, 3 to 6 years?
Very possibly. Very possibly. So a couple of questions on the paid leave here. And this question in from Mike with a follow-up from Alicia. So in regards to paid leave, if we do choose to offer it, will we be able to claim the credit in 2021?
Yes, the tax credits still exist through March 31st as of right now.
Gotcha. Thank you. And then in follow-up from Alicia, if the employer is allowed to continue, if the employer continues to offer COVID paid leave, as long as they don't exceed the 80 hours per staff member, ?
Well, this is going to be, it's no longer a legally required benefit. So this is going to be a decision you're going to make about how you want to support your employees. You obviously can give as much leave as you wish to support your employees, but what you do for one, you must do for all, right? For a similarly situated employee. So if you always want to think not only about case one, but what happens if unfortunately you're at case 20? What can you financially afford? So if the first person that receives COVID, you give them 3 weeks of paid leave because, they have a sick husband and a sick child at home and you're worried, but then the 20th person that receives COVID happens to be single and has no dependents, you're still giving them 3 weeks of leave because what you do for one, you have to do for all.
Yep. Very good advice there. This is probably a Stephanie question. If my company received a PPP loan of under $2 million, how concerned do I need to be about an audit?
So SBA has said that they intend to audit all loans that are above $2 million. They haven't said outright that they won't audit any that are below $2 million. So I think that, best practices are to obviously make sure that you keep all of the required records, that as you're going through the various forms that you're making accurate certifications. But I think as far as how much of a risk, I think unless there is a specific situation or instance that kind of puts you on the radar, I think if you're under $2 million, I wouldn't be too concerned about the possibility of an audit. Like I said, it always stands out there as a possibility, but I think that they are going to be busy enough doing the audits of companies over $2 million. I don't know how much focus they're going to spend on those smaller loans.
Thank you. Going down that path a little further then, so if the SBA determines that a company was ineligible for the loan or ineligible for loan forgiveness, let's say, is there a challenge route to that through the SBA?
Yes, there is. So as of right now, I believe the process is that once you get a final determination from the SBA and you get that notification from either the SBA or from your lender that you either were deemed to be ineligible or that you're not entitled to any forgiveness or full forgiveness, that you have the ability to appeal that. You need to make that, start that process within 30 days of receiving that information. I think that we will likely see some changes or modifications to this, in the coming weeks. As I mentioned, SBA has been asked to sort of put together this audit plan. They're planning to come out with additional interim final rules regarding the forgiveness process. So I think we may see more information about what that appeals process looks like once we get that additional guidance and regulations coming out.
Terrific. Thank you. Well, we're close to the top of the hour. I think we have maybe time for one more question. And here it is. And this is probably a Kathy question. So is the paid leave in 2021 no longer reimbursable or credited? I know you mentioned a March 31st deadline there as well, too.
Okay. So there is no requirement for paid leave. There is still a tax credit available through March 31st. As of this moment, they could extend that if, we still continue to see COVID cases rise and issues come up. I did want to touch on one other thing before I forget, which is government contractors specifically need to be aware because they have to file OSHA reports every year, but also so do other manufacturers and everything. COVID exposure at work is a recordable event. And if COVID exposure leads to major illness, it would be a reportable event. And there's contact tracing requirements and everything else like that. So something else to keep in mind as you're dealing with the 1,000 things plus COVID.
Wow. The list never seems to end, Kathy, but unfortunately this webinar now has to. It's about 1 minute after 1 o'clock. We appreciate everybody's attention and great questions in joining us today. Our contact information for our entire panel of experts is going to be listed. Like I mentioned earlier, this is going to be recorded, and it's as simple as a point and click on the YouTube channel to reach out to any of our 3 people here. And I'm sure they'd be more than happy to field your questions. But on behalf of everyone, thank you so very much for joining us. We hope you can join us in the next webinar in the upcoming weeks, where we're going to discuss COVID-19 employer liability referenced earlier. I'm sure that'll be a lively discussion. Until then, everybody be safe and healthy, and thank you very much.